and welcome to the inaugural Equip Super Annual Member Meeting. We've been very excited about this opportunity to meet with you today, and we're delighted that so many of our members have been able to join us. My name is Danny Casey. I'm the Deputy Chair of the Trustee of Equip, and I have the honour of welcoming you and outlining what we'll cover today. So on behalf of my fellow board members and the Equip Executive, I'd like to thank everyone who's taken the time to join us today for this important occasion. I can confirm that we have a quorum of directors, as well as our auditor and actuaries. And as such, our annual member meeting is ready to go, and I'm pleased to declare it officially open. I'd particularly like to acknowledge the traditional custodians of the land on which we're meeting today. I pay my respects to their elders, past and present, and any Aboriginal elders of other communities who may be joining us today. And normally we'd be acknowledging the traditional owners where we're standing in a specific place, but things are a bit different in these COVID times. This map from the Australian Institute of Aboriginal and Torres Strait Islander Studies gives us a terrific overview of the richness and diversity of Aboriginal and Torres Strait Islander Australia. I'm based in Sydney, speaking to you from there. Some of the people you'll be hearing from today are based in Melbourne, regional Victoria and Queensland. And I know we've members joining us from many different locations right around Australia. So I'd also like to acknowledge the traditional custodians all around Australia. Thank you to all who are joining us today. At the start of the meeting, I think it's very important just to make sure that we're all aware that the information presented in our presentations is general in nature. It must be. It concerns the fund as a whole. So it doesn't take into account your personal circumstances, such as your individual or financial investment or financial objectives. But if you'd like individual financial advice, well, we do have advisors in our team who can assist you, and we'll include those contacts at the end of the presentation. But now, I thought what I might do is run through what we'll be covering this afternoon. This is the agenda. Firstly, we'll hear from Andrew Fairley, our chair, who'll make some remarks and brief you on behalf of the board. He'll include comments about our history, our vision, overall performance, and a look ahead at our future strategy, as well as commenting on changes happening in the industry. We'll then be joined by Scott Cameron, our Chief Executive Officer of Equip. He'll speak next, covering our high-level financial performance and what we've been doing for members, especially through this recent, very difficult and challenging year. We'll then hear an investments update from Anna Shelley, our Chief Investment Officer. He'll then give us some details about the investment strategy and performance, and also make some comments about the current economic environment and the many challenges that are out there presently. We'll then have an opportunity to answer the questions submitted by our Equip members. And we were delighted to receive so many questions prior to the meeting. I think that demonstrates your engagement, and indeed that's wonderful from our point of view to have you engaged, because we seek to serve your retirements to bring the best financial interests to the table. And so it's wonderful to have an opportunity to engage with you and explore any of the questions you have. Now, you can ask questions during our webinar today by using the Q&A function within Zoom, and that's on the bottom, as probably everyone knows now, the bottom right-hand part of your screen. We'll do our best with time. We may not have time to get through every question. We'll certainly start with answering all the questions that have been submitted, or as many of those time permits, prior to the meeting. And please note that at this meeting, again, just a general reminder that the questions will be general in nature. If you have specific questions about your personal circumstance or your account, then again, our team's waiting. The contact details will be available for you at the end of our session today. And also, just please be assured, we will be providing written responses to all our questions, including the questions that might be there on the chat today. As well as that, we'll be publishing the minutes of this meeting on our website. And we'll plan to do that as quickly as we can, about the end of this month. So all documents will be available there for you to peruse. And again, any further questions afterwards, please contact our team. So now, with some of the order of events and the administrative side dealt with, I'd like to introduce Andrew Fairley, the chair of our trustee, the chair of Equip Board. He's the founding chair of Together, of which Equip is a part. Andrew brings a wealth of experience and skill to our fund, having worked and advised in the industry for well over 30 years. He served as the Equip Chair for well over a decade, and this will be his last year as Chair. So it's a wonderful occasion. Please join me in welcoming Andrew.
Thank you, Danny, for that introduction, and let me add my welcome to all of you on this inaugural annual member meeting. As Danny said, we're joined by a number of our important service providers to the fund, and I welcome them, and I particularly welcome representatives from our regulator, APRA. We're also joined by all of our board members, and I'm going to introduce them to you. I already met Danny, who's currently, as you know, our Deputy Chair, and I'm delighted to advise that Danny has been appointed as the Chair of the fund from 1 July this year when I retire. I want to congratulate Danny and to express our confidence as a board in his experience and leadership in taking our fund forward. Let me introduce our board members, or let me tell you a little of them. Justine Hickey is with us today. Justine's from Brisbane, and she's chair of our investment committee, and she will be part of our Q&A session a little bit later on this afternoon. Penny Davey-White is a communications and marketing expert from Canberra. Obviously a board member. Carolyn Harkin, who has a strong finance background from regional Victoria. Jan Decker, a very experienced investment professional from Melbourne. Mark Kershay is on our board and one of Australia's leading specialist superannuation lawyers. Michael Clinch, Melbourne-based and an HR professional and executive with AGL, one of our large employers. Peter Hasey from regional Victoria is a highly experienced trustee director. Simone Thompson from Northern New South Wales, as a board member, is a specialist in governance and compliance, and in fact chairs our Governance and Rewards Committee. Deb James from Melbourne is the General Secretary of the Independent Education Union, and that was actually in Victoria and Tasmania. And finally, David Doolan from Melbourne, who joined our board last year, and he's a former senior finance executive with Rio Tinto. So you can see we've got a pretty high calibre board in terms of our skill sets to bring to the issues that are pertinent to managing your money. This year has been incredibly difficult for us all, but whilst it's been challenging, we should remind ourselves about where we've come from, what we've achieved during this last 12 months, and to look back and to celebrate our heritage and our purpose. We commenced, or Equip commenced life as the State Electricity Commission Fund in 1932. We're one of the oldest superannuation funds in Australia. You can see on this slide a number of the major milestones that trace our history and tell a consistent story of growth. And clearly the latest joint venture with Catholic Super is a particular highlight of that mapping. In 2021, I'm pleased to say that for the last 90 years, we've been working tirelessly for you, our members, and we're incredibly proud of the fact that we've been able to do that. And whilst a lot has changed over those years, our vision, our purpose, and our commitment to our members has remained absolutely constant. Our reason for being is to support our members to prepare for financial freedom in their retirement. And it's the foundation of everything that we do at Equip. During this last financial year, 1920, we entered our JV with Catholic Super and its other various brands. And it's the biggest transaction that we have ever undertaken. It significantly increased our overall size, and it's improved our ability to deliver our promise to you, our members. And the manner in which the JV has been negotiated has enabled us to deliver benefits sooner rather than later. That's because some years ago at Equip, we applied for a license from the regulator, APRA, to act as trustee of more than one fund. That's called an extended public offer license. Now, we're one of the first funds, if we weren't, we may have been the first fund in Australia, but we're certainly the largest fund to have gained one of those licenses. And it's a really innovative approach that we took at the time. The reason we were able to join with Catholic Super into this joint venture is because Together Trustees, which used to be called Equip Super Proprietary Limited, Together Trustees now can act as trustee of more than one fund. So we're trustee of both Equip Super and Catholic Super. That gives us the opportunity to make savings straight away with one CEO, one chief investment officer, one board, and one executive team. And that makes a significant difference in terms of the immediacy of the savings that we're able to bring to the table. The increase in size in investable assets and management capability has enabled us to develop a highly skilled leadership team. We know in organizations that when you have the capacity to grow, you have it's easier to attract the best quality people. Our JV has been delivered at the same time as we have ensured that you, our members, were supported all the way through this time of need, a pandemic the likes of which none of us have ever seen before. These are two funds which were in the top 10 profit for member funds, two of the highest performing funds over the last 10 years. So it was logical for us to want to speak with Catholic Super. We share similar values, ideas, our commitment to our members. We have the same administrator, the same custodian, the same asset consultant, and we both have a laser-like commitment focusing on members first. This was such a logical arrangement. We've already derived significant trustee office savings in the way in which I've identified with one CEO, one executive team, and so on. And we will benefit more from additional savings when the two funds merge together and a successor fund transfer on the 30th of June. The savings emerge from reduced investment fees through the consolidation of managers. The savings that we make go to offsetting our increased costs of operation and provide enhanced services to you, our members. Our strategy to achieve scale is to operate at the existing fee levels and to continue to absorb the additional costs of running businesses that we all endure through the savings that we make from this really successful joint venture. Another great advantage for the fund of the joint venture is the membership diversification that it has offered to us. The membership base of Equip is energy, mining, and infrastructure, whereas the Catholic Super members are essentially in the healthcare, aged care, and education sectors. Diversification of membership is an important part of fund resilience going forward, as we've seen during the pandemic when a number of different sectors were harder hit when the lockdown happened and people lost their jobs or were put on JobKeeper. We strongly believe that smaller funds don't have the scale to be able to provide value, to give the service levels that are necessary and the consistent quality returns to members that's driving our strong growth strategy. We think it's essential that we have to maintain our growth to scale up. We continue to have dialogue with other funds to join us under our extended public offer license. And we're active in merging with other smaller funds on a graduated basis. So this year, we've merged already with the Pitcher Partners Superannuation Fund. We're about to bring in the Toyota Superannuation Fund that will become part of Equip in May this year. And we announced this week that the BOC Gas Fund has decided that they want to merge with us also, and that will happen in the new financial year. So as a result of this iterative merger arrangement, we're bringing in almost another $2 billion in funds under management. It's just a further manifestation of our goal of trying to achieve $50 billion by 2025 with 300,000 members. We see that as an essential growth objective. An important benefit of our JV is as a larger, more influential organisation is to attract and promote talented members of our team. It's really important to us that we provide our employees with a growth pathway. We pride ourselves on our skills-based board. We have a robust process of reviewing our board annually, and we put together a skills matrix each year. We analyse what skills our board has and what skills they need to have. We only appoint directors based on the skills relevance to our needs at the time. Our current board structure is 1/3 member directors, 1/3 employer directors, and 1/3 independents. That gives us a much broader skills base to attract the best candidates for our board than certainly a broader skills base than the traditional industry fund board nomination model. So let me give you an example of the depth of skills of one of our board members. Jan Dekker joined our board 4 years ago and is a member director. He's an experienced CEO with particular expertise in funds management, in venture capital, and in clean technology. He has played a significant role in assisting the development and implementation of our environment, social, and governance policies. That's our ESG policy. It's clear to us that socially responsible investing is a strong and ongoing concern for you, our members. And Jan is helping us to exhibit leadership in that area. The board has developed a responsible investment policy, which has a particular focus on ESG investing. At our board meeting in December 2020, we made a commitment that Equip will target net zero emissions by 2050. Following the commencement of our JV in October 2019, we expanded to a board of 12 people as a transitional governance model. But as from 1 July this year, we'll move back to a board of 9, which we believe is the optimal number for us in the future. So 3 of our board members, including myself, will step down. We're likely to retain that number unless there is another opportunity for a JV or a merger, which might then take us back up again into some sort of transitional arrangement. I want to point out that there's currently opportunities for a new member director and employer director. In April this year, we will be listing the specific skills that we need to have in an employer director and a member director, and they will be available on our website. If you feel as though you have an interest in becoming a board member of Together Trustees, please have a look at that and see whether the skills that you have match what we need. And by all means, put in an interest with us. Let me talk a little bit about our CEO. We've been fortunate to secure the services of Scott Cameron as the CEO of our joint venture. He joined us, it's well over a year ago now. And it was pretty difficult circumstances bringing 2 organisations together in separate offices in different parts of Melbourne, as well as coping with COVID and a turbulent investment environment. Scott is really providing outstanding leadership to our fund, and I'm going to introduce him to you in a moment. I want to say something about our industry. We've seen a lot of change in the superannuation industry over the past year, aimed at putting the interests of members first, and you would have read quite a lot about it in various media outlets and government announcements. It includes low balance or inactive accounts being transferred to the ATO. It includes members needing to opt in for insurance in particular circumstances, such as if you're under 25 or you have a low balance inactive account. Members have been allowed to withdraw money if they're suffering financial hardship due to COVID. There are other changes that are in the wings right now being debated by the Parliament. Much of this goes back to the need for fund consolidation. And consolidation of funds is a constant now in our sector. Now more than ever, it's likely there'll be significant merger interest because other boards are recognising that if you're not a $10 billion fund or larger, it's going to be increasingly difficult for you to survive, to be sustainable, and to continue to act in the best financial interests of your members. Your fund, the Equip Fund, is really well positioned. As a result of our joint venture, we have in excess of $28 billion, and as I've said before, we're growing with these various mergers that we're undertaking. But our challenge is to continue to build our funds under management, to continue to build our membership to 300,000 members so that we can become even more scaled and even more successful in ensuring that we look after you in the best way possible. Putting members' financial interests first continues to be our core principle as we grow and scale up. We passionately believe that it will deliver better outcomes for you, our members, and it will, by attracting and retaining staff and leadership, it will be the best possible thing for our leadership team and our staff, and it will bring efficiencies of scale in every respect. This goal to be 50 billion by 2025 is achievable, and we believe that our strategy is the right strategy to be able to deliver that. In relation to ongoing merger discussions, however, they will only be pursued where those funds have similar values, similar commitments to those that we have, and that any JV or any merger will be in the best financial interests of you, our members. On behalf of our board, I want to thank you for your ongoing support of our fund. It's really a privilege for us to be the custodians of your vital retirement assets, and we commit to continuing to pursue your best financial interests in our stewardship role. It gives me great pleasure now to introduce to you Scott Cameron. As I indicated, Scott is the CEO that we appointed following the JV, and he's had some great successes during pretty difficult times. He's the CEO of both the Equip Fund and also the Catholic Fund, and he brings significant experience to these roles from the financial and the corporate sector. Scott's going to talk to you today about fund operations, about our financial performance, and how we have helped members through a very difficult time. Will you welcome Scott Cameron? Thank you.
Thanks, Andrew, and a very good afternoon to all of you. As Andrew mentioned, it's been a very difficult year for a lot of people, and I'd like to thank all of you, our members, for your support and help throughout the year. I'd also like to thank all of our staff, a number of who are dialing into this meeting this afternoon. They've put a tremendous effort in over the last, really since the start of the joint venture, but particularly over the last 12 months of COVID. They've achieved some great outcomes during these very challenging times. And I can hand on heart say that they always have put our members' interests first. Our team moved 100% remote working very quickly. They coped admirably with Melbourne's very long lockdown and made sure our focus remained on giving you, our members, the best possible retirement income. In particular, I'd like to thank all of you who are essential workers and have done so much at greater risk to yourselves and your families to help us get this far. I know we have many members in the energy, resources, water, infrastructure and manufacturing sectors. Andrew mentioned earlier that the joint venture allowed us to put together a very strong board and senior executive team, and that's also true throughout the organisation. The joint venture and our increased size has allowed us to put together a fantastic team with great leaders and specialists at all levels of the fund. Our combined team's deliberately been structured to give us all the skills we need to meet our growth agenda, as well as deliver on the day-to-day services and also stay on top of the very changing and ever-changing compliance landscape. We've brought together complementary skills from both funds, but also introduced some new funds where required. Skills where required. Our investment team, headed by Anna Shelley, all have significant experience, an average of 20 years across the team. And we're great believers in the importance of diversity, so we're very proud that more than 50% of our senior leaders and executives are women. We realised quickly that the COVID-19 pandemic was likely to offer serious challenges to many of you, so we moved swiftly to make sure we were ready to help. We know that the reason we are here is to help you gain financial freedom in retirement. So we made sure we didn't lose our focus on getting a positive investment return for you. Our 1.3% return for our default option was an excellent result amid a very difficult year where many funds lost money. We quickly transitioned our team to working remotely and put together a specific help hub and communication campaign to make sure you all knew what was going on and how we could help you. And we're very pleased that these changes we put in place were so well used by members. And you can see by the numbers on the slide that particularly we're able to help many of you gain access to your money if you're suffering from financial hardship or needed to change your investment options if the pandemic had disrupted your retirement plans. Andrew mentioned our purpose before, and that being to prepare you for financial freedom in retirement. And that's what all of us work towards every day. As a profit to member fund, any increase we have in profit, any money we save, ultimately gets used to try to either give you a better retirement or to improve our products and services to you. Part of the money we're saving as a result of the joint venture with Catholic Super is getting used to improve our services to you. So what I wanted to talk about now was some of the things that we're working on. Digital. We're always trying to improve our digital services. We know that many of you like the flexibility of doing things yourselves and whenever you want. So we offer a digital service which helps you understand your products and manage your own transactions. We also have calculators that let you set out a number of different scenarios for your super to give you a better understanding of what's best for you. Communication. We've expanded and improved our communication, including mid-year newsletters with balances, annual statements, personalised content, all intended to support you in maximising your retirement outcomes based on your personal circumstances. Financial planning. We know how useful our financial planning team has been for many of you. So we've expanded that team so more of you can get individual financial advice and more quickly. We've enhanced our contact centre. Many have told us that while digital is great, sometimes you want to speak to a real person. So we've enhanced the capacity of our contact centre so it's easy to talk to someone when you need to. And this has been particularly useful during COVID as call volumes have increased substantially. And insurance. We've refined and enhanced our insurance offer to members, including the adoption of the insurance code, delivery of a life cycle insurance design, and increased claims expertise and support. For most of the last financial year, the stock market performed very well, and then when COVID-19 arose, it took the worst market downturn since the global financial crisis. Pleasingly, we bucked the industry trend by delivering members positive returns for the 2019-20 financial year. Our balanced growth option returned 1.7%. This is top 10 investment performance, 2.5% above the super ratings median. And our default My Super option returned 1.3% over the same period, another very strong result. I'd like to acknowledge the excellent work of Anna Shelley, our Chief Investment Officer, who you'll hear from shortly, and her team, who have really done an amazing job in delivering these returns over the past year in very difficult circumstances. Our long-term returns are also very good, well above industry averages. The chart on the slide shows how Equip members who had a balance of $200,000 in their Equip My Super investment option in 2015 would be $4,500 wealthier after 30 June 2020 than someone who invested in a comparative average retail fund, and $3,750 better off than someone in an average industry fund. We received a few questions about fees for this meeting, and I know our service centre also gets calls and emails. So I wanted to address the issue. Yes, our fees did increase in October 2019. However, Equip remains one of Australia's best value super funds. Our fees are still lower than the average super fund and lower than the average industry super fund. And using a balance of $50,000 and our default My Super investment option as an example, Equip charges fees of $482 per year. The average industry fund would charge $495 and the average retail fund $650 per year. So when I talk about fees, I like to talk about total returns because I know that's what's important to members. That is how much money is in your account. So when our fees are lower and our returns are above average, higher, then that contributes more money to your account, which is a great result. And it's also great that we're getting external recognition for what we're doing. We won Money Magazine's best, cheapest retirement product, assessed on the lowest price retirement product for members with a retirement account balance of $250,000. And in the 2019 Selecting Super Awards, we also won Best Value Insurance, Equip My Super product, and Best Insurance High Risk, Equip My Future product. And My Future Sustainable Responsible Investment option was a finalist in the Money Magazine's Best of the Best Awards 2020. This category ranks super products that invest according to environmental, social, governance principles, including being ethical, green and sustainable, plus social impact and renewable energy. We were the highest performing over 1 and 3 years, as well as the cheapest of the 5 finalists. And we're also delighted to be able to continue our 15 years unbroken run to receive independent ratings agency, Super Ratings, highest platinum performance rating as a best value for money fund. It's awarded to only the top 15% of funds. So I'd now like to introduce Anna Shelley, who is our Chief Investment Officer at Equip. And Anna will give you further detail on our investment strategy, performance, and the current economic environment.
Thank you, Scott, and a warm welcome to all our members. Before I talk about our investment performance and current economic conditions, I'll explain a bit about our approach to investment. Firstly, we focus on active investment management, which means being prepared to be different where we see risks or opportunities to earn great returns from your money. Then we select specialist external managers who are experts in their field, the same way that you might select a specialist surgeon if you needed one. We diversify your investments across different countries and different types of investments like shares, property, infrastructure and bonds, and we do that in order to balance the risks. And we also look for global opportunities which might not be available to individual investors to increase returns and further diversify our investments. The aim is always to buy low and sell high, but this can be hard to do when you're managing your own money. We have decades of experience and we follow that discipline strictly. An example of the type of investment which we're able to give our members access to, which it might otherwise be difficult to get access to if you were managing your super yourself, is Flinders Ports. It's South Australia's leading port operator. It was formed in 2001 after being privatised by the South Australian government, and it includes 7 ports and employs over 800 people. It's a major contributor to the South Australian economy, and it's also a great investment. It's delivered 16% per annum returns since 2015 for our members. Now, I'd just like to talk a little bit about responsible investment. As Andrew discussed, we believe that environmental, social and governance factors, or ESG factors, for short, influence overall investment returns. So if we keep these factors in mind when we invest our members' money, it will increase the overall risk-adjusted returns for our portfolio. Our investment team reviews our investments before we make them at an asset class and fund manager level, and we examine the ESG factors of each holding. We promote strong ESG policies in our investee companies and also in the broader investment community. We are also active in exercising our voting rights in support of good governance and a sustainable economy. Our key achievements this year include enhancements to the management of our Aussie equities voting practices, and we also made a commitment, as stated in our responsible investment policy, to progress the fund towards implementing the Task Force on Climate-Related Financial Disclosures Recommendations, or TCFD. And finally, in December 2020, to further reinforce our commitment, the board approved the adoption of a target for net zero emissions by 2050. And you might have seen this in the latest member newsletter. Now, onto returns. Our flagship balanced growth option has returned 8.3% per annum for the last 10 years to 30 June 2020, and that's after investment fees and tax. It has 70% invested in growth style assets. So what we're doing is we're balancing the need for long-term growth with the need for shorter-term safety when markets are rough. And that balance and diversification is just what's needed when markets are volatile and crashing. The objective for the Equip Balanced Growth investment option is to return 3.5% per annum above inflation over a rolling 10-year period. Now, the average inflation rate over the last 10 years has been about 2.1% per annum, so you can see that we've substantially exceeded that objective. It's important to note here again that these figures are after investment fees and taxes. I know many of our members are interested in fees, and absolutely fees are something that we minimise as much as possible. But the most important figure is the net return after those fees and taxes, as it shows exactly how much your savings have gone up or down. Our investment objectives vary from product to product, as we have different products to suit people with different objectives, different risk appetites, and people who are at different life stages as well. Over the last 10 years, the median or average return for a comparable super fund is 7.1% per annum versus our balanced growth option at 8.3% per annum. So you can see that we've also substantially outperformed the average super fund as well. If you've got more queries specifically related to your investment choices, we do offer a team of financial planners who are available to assist. So the next slide shows our range of diversified investment options from left to right, the more conservative to our more growth-oriented options. And you can see very strong returns over the last 10 years along the bottom line of the table. You can always find out more and keep up to date on our investment returns on our website. Lastly, let me talk about current market conditions. Equity markets have risen substantially since the end of June. They're up between 14 and 20% to the end of January. The market recovery has actually been one of the quickest on record. We invested a large amount of our cash into equities as the market was bottoming last March, and that has really helped returns. The good news is that our balanced growth and MySuper options are up 8.5% from the end of June 2020 to the end of January 21. And that's a great start to this financial year and also makes up for last year's slightly lower returns. So why have markets rebounded so strongly? Well, this has been largely due to the strength of the stimulus provided by governments around the globe and particularly in the US. Central banks have also moved to keep interest rates low, and the market is very confident that rapid vaccine deployment will be able to contain the COVID-19 virus and minimise any ongoing impact. In the last few weeks, however, we've seen bond markets falling, which means negative returns for many bond or fixed income investments. The strong selling in the bond market has occurred as investors have become less certain that interest rates will stay low for many years ahead. On the one hand, this reflects a market view of stronger economic growth going forward, so that's positive, but it also incorporates a concern that inflation risk is increasing and a concern over the high levels of global government debt, which may not be sustainable. Bond markets can tend to be the canary in the coal mine, and so this development is something that we're keeping a close eye on. But we're well positioned for this with only very low holdings of bonds that are sensitive to interest rate movements. Cash rates also remain extremely low and are an ongoing challenge for us in delivering our investment objectives for you, particularly for those conservative style options that have large holdings of cash for stability and liquidity purposes. And other risks remain, including the actual efficacy and the rollout of vaccines around the globe, the potential rise of inflation down the track, and there are pockets of irrational exuberance in markets, in equity markets, particularly US technology stocks and some retail investor darlings like GameStop. And finally, we have the question of if and when that stimulus that's been provided to markets might be removed from the system. So in sum, we continue to balance all these risks, and diversification of your investments remains a key tenet of our investment strategy on your behalf. We also provide investment updates on our website if you're interested. And with that, I will hand back to our Deputy Chair, Danny Casey, for Q&A. Thank you.
Thank you, Anna. And thanks, Andrew and Scott, for that update. We certainly enjoyed having this opportunity to provide a bit of a briefing on much of the great work we've had underway in your fund. It's now time to start responding to a number of the questions we've received. But before we do that, I wonder whether we could just take a moment or two to acknowledge the extraordinary contribution that Andrew Fairley has made to our fund. Andrew has been the chair of our fund for nearly 12 years, and during that time has guided the fund through a number of important enhancements that have improved member outcomes. The establishment of advice and the pension offerings was one important step. The conceiving of the regulation, receiving regulatory approval for the extended public offer licence so that we could achieve scale without losing identity was another extraordinary achievement. The focus and drive, almost a passion he has, Andrew, for skills at the board level, because that will enhance member outcomes. The merger with Rio Super and most recently the merger with Catholic Super, enormous achievements over his time as the chair of our fund. He's been the voice of reason and an advocate for members in our industry for many, many years, an outstanding contributor, a thought leader. So Andrew, on behalf of all of us here, thank you for your professionalism. Thank you for your judgment, and thank you for your contribution to our fund. We are much better off for the service you've done over many years. I'd now like to turn to the member questions, and we'll use as many as we can in the time available. We will respect everybody's time for our webinar today. The first question we've got is from Anthony, and Anthony is, thank you, Anthony, for the question. He'd like to know how the merger with Catholic Super has reduced the management expense ratio. And I might see whether Scott could respond to that one, please.
Sure, Danny. Thanks for the question, Anthony. As we spoke about in the presentation, we are expecting significant savings in the first 5 years of the joint venture with Catholic Super. And as a result of the innovative extended public offer model, which we spoke about, we've actually already started realising some of those efficiencies and savings, which are sort of ahead of time than what a normal type joint venture structure or merger may have been. So We've been able to make some of those efficiencies, such as one board to oversee the two funds, one management team, for example. However, there's also substantial one-off integration costs with bringing two funds together and also achieving some of those savings. And we do need to offset those against the savings realised to date. We also need to invest some of those savings into the ever-increasing compliance obligations and also into products and services to the membership. So we estimate that net savings will start flowing in the next 12 months to 24 months from an administrative perspective. We have started realising savings on investment management fees, and some of these have already been reflected in Equip's unit price. And they do come about by the consolidation of investment managers between the two funds, but also the fact that we're now a bigger fund, we've got more buying power and scale. And so again, we've been able to leverage that in getting better fee outcomes as well. When we do the successor fund transfer later this year, that will become another step where we can then start realising the next another sort of tranche of cost savings again. I think it's also important to understand that we are a profit to member fund, and so all the savings that we do make are either going to be reinvested in new products and services or passed back ultimately in the form of fee savings.
Thanks very much, Scott. Actually, while I've got you there, I've got another question from Michael about the same sort of areas there. Equip Super, says Michael, fees increased recently. Other funds are charging less than Equip and have better performance. So why should I stay? Would you mind responding to that for us, please?
We hope after you do stay with us, Michael. Every member is a valued member. And as I mentioned before, Equip's admin fees did increase in October 2019. However, we do remain one of Australia's best value super funds. Our fees are significantly lower than the average super fund and also lower than the average, retail fund, but also lower than the average industry fund. Based on data from Chant West, using a balance of $50,000, our default MySuper investment option as an example, then the Equip fees charged would be $480 per year, and the average industry fund would be $495, and the average retail fund $650 per annum. And when Equip's investment performance also been consistently above the industry average for many years, I think that is overall a good outcome. When you take that together, our fees and investment returns, so what we call our total return, that they compare very well against competitors in the marketplace. So, Michael, we do hope that gives you comfort and a lot of reasons today for staying with the fund.
Thank you, Scott. And Michael, thanks very much for raising it. We're pleased to have an opportunity to respond. We move away from fees to returns now. A question from Annie, who's asking us if we can address expected rates of return over the next few years to come. And I wonder whether Justine, the chair of our investment committee, might respond to Annie for us.
Thanks, Danny. And thanks for the question, Annie. It's an interesting one. So we've had very low interest rates and low inflation for the last few years. So we are living in a low return environment. And what does that low return look like? Well, last calendar year, the Equip MySuper returned 4.8%. And then over the previous 3 years, it averaged 6.4% per annum. But as we know, of course, past returns are no guide to future returns. And as Anna mentioned, there are quite a number of risk factors playing out in the markets at the moment. So I'd suggest probably the best rule of thumb looking forward is to look at the CPI plus target for your particular investment option. For example, the MySuper target is CPI or inflation plus 3.5% over 10 years. And that 10 years is important. It reminds us that super is a long-term asset and that we're long-term investors. And so in managing your retirement savings, we're aiming to maximise the return for your given risk profile over that long term. I hope that helps.
Thanks very much, Justine. Now moving to a slightly different angle on the fees. A question from Felix. So what is the rationale for basing asset fees on your account balance? And Felix says, does it cost more to maintain a higher balance account? Perhaps, Scott, you might be able to help with that one for Felix.
Sure, Danny. Felix, as I mentioned before, we are a profit to member fund. And so unlike some other superannuation funds, we don't have shareholders and all of our profits are used to benefit our members. So we do manage our costs carefully and we try to keep our fees as low as possible. But we also try and make sure our fees are as fair as possible for all members for as long as they're with the fund. And so we do this by charging two types of administration fee. There's a flat weekly fee and an asset-based fee, and the flat fee per week is $1 and the asset-based fee is 0.25% on an account balance up to $500,000. And we do this to strike the balance on how we levy fees across the whole membership and to make the cost of administration more equitable throughout a member's time in the fund. So for members with small balances, the weekly fee in percentage terms is obviously bigger than the asset-based fee, and that's true up until balances of around $21,000. And for members with higher account balances, the weekly fee in relation to their account balance becomes smaller as the account balance increases. So it's important to note that if the asset-based fee is not charged for the portion of the account in excess of $500,000 to make sure we also keep things fair for people with higher balances. So hopefully, Felix, that gives you a better understanding of what we do, why we charge that asset-based fees.
Thanks, Felix, and thanks, Scott, for that reply. Got a question from James, who's asking if we can discuss the current and ongoing exposure we have to the coal economy. Justine, I might invite you back into this one, please.
Thanks, Danny. And thanks very much, James, for the question. As we have discussed, Equip has adopted a commitment to achieve net zero emissions by 2050. So as you'd imagine, our exposure to the coal economy is getting a fair bit of attention. Around 5% of our investments are in the broad sectors of metals and mining and oil and gas. And I thought it might be helpful just to try and unpack how we think about those sectors. So in terms of coal, with thermal used to generate electricity, we are very conscious of the risk there, particularly as the risk of stranded assets. With coking coal, however, we see that it has an ongoing role in the production of steel. And so we're more focused on how emissions can be minimised in these processes. So essentially how the companies involved are managing this transition. More broadly, in those sectors, we see that there's a role for gas, iron ore, copper, rare earths. So we're not anti-mining, but we are very interested in how our investee companies are making that transition to be carbon neutral alongside us. And you'd probably be aware that a number of companies are already making significant investments in the renewable space. I should also mention that we do partner with ACSI, the Australian Council of Superannuation Investors, and they assist us with engaging with these companies and advocating for improved practices and disclosure. Thanks.
Thanks very much, Justine. We might have another question here. I'm just very conscious of time. We've got about 6 or 7 minutes to go. We've got a question which I might see whether Andrew could respond to from Christian. Andrew's asking, when will a new member representative be added to the board? Andrew, would you be able to respond to that, please?
Yeah, thanks, Danny, and thanks, Christian, for your interest. Perhaps you're asking it on the basis that you might be a potential member director. I indicated in my address that we're currently a board of 12, and we're going down from that transitional governance arrangement to a board of 9, and that will include a retirement of a number of people. Because we have staggered board timetables that board members retire on a graduated basis, because we have 4-year terms, this year we actually have a member director place and an employer director place coming up for a placement into the board from the 1st of July. Will we as a board have a very significant focus on the skills that we need. And so we allocate to each of those positions particular skills. And you will see, I think it's in April, that the skills will be put up on our website as to the skills that we're looking for. And that will then go through the process of being assessed against both the skills we need, plus obviously the baseline fit and proper skills that a director needs to have in order to be a director of a registered superannuation entity. And so we will have a new member director with effect from 1 July. And I'm encouraging anybody who thinks that they have something to give to this board and who fits the skill criteria, the opportunity to please put in an application and see whether you might want to join us on our journey.
Thanks, Andrew. Thanks, Christian. Thank you very much. I've got an investment-related question. Can Equip Management advise how much of the capital is being traded by hedge funds, directly or indirectly? Anna, I'm wondering whether you might be able to respond to that one, please.
Thanks, Danny. Yes, that's a quick one. We've got a small allocation to hedge funds. It would be less than about 5%. Why do we hold them? Basically because hedge funds or alternative assets altogether provide diversity of returns to other more traditional investments like equities and bonds. And as an example, back in March 2020, when the market was first crashing down after COVID sort of erupted, we had equity markets fall by around 10 to 20%, but our largest hedge fund investments had returns in that month that were flat or positive. So in a nutshell, that's why we hold them. Thanks, Danny.
Thank you very much. Thanks. I've got a question from Gwendolyn for you, Scott. I think it might be best if you might answer that, if you could. What security do you have in place to keep my personal information and my money safe?
We have a lot, Gwendolyn. That's the short answer, but I will expand a little bit more because I'm sure that's what you'd like me to do. We do have a great range of security measures in place, and some of the main ones are, we ensure your personal information is secured and accessed only when it's necessary and only by the people that need to access it. We verify members' identities before communicating with you, before updating details or before releasing any information. We apply enhanced security measures when we become aware that maybe there's a heightened risk on a member's account. So, for example, if a member advises that they've had an identity fraud, for example. We also constantly monitor and maintain IT security systems to detect malicious traffic and threats and prevent them. And while there isn't a common benchmark that rates security controls, we comply with APRA Information Security Standard CPS 234, which also governs information security for other entities regulated by APRA. But I think it's also important to note that there's things a member can do as well in order to make sure that, or give best chance of information being secure and data and balances. So, basic things like not sharing passwords, not providing personal information. Again, if you do have suspicions that your account's been compromised or not necessarily your superannuation, but some other form, then let us know. And again, we can put that heightened alert on your account. I think one other thing I'd just like to mention is that one of the benefits of the joint venture is we now have, even more scale. And what that does allow us to do is invest in even more in important areas like information security. And so we'll continue to do that. And I think ultimately the members will be beneficiaries of that.
Thank you, Scott. Gwendolyn, it's a key priority and a big focus, and I trust those comments helped. We're right on time now, so we've actually got one last question we might try and squeeze in if we can. I am getting the wind up. I was conscious we'd have to finish right on time, but I've got one from Saurabh to you, Scott. What benefits can independent contractors expect in terms of services from Equip Super going forward? Things such as financial planning.
Yeah, thanks, Danny. Look, it doesn't matter whether you join us directly through an employer or whether you're a self-employed contractor. You'll get the same benefits when you're with us, and you get the same access to the same tools and calculators, that assist in your retirement planning. And we've also got, as I spoke about before, a dedicated team of financial advisors who are skilled in supporting members in relation to optimising their superannuation outcomes, and they're available whether you're an independent contractor or through an employer. So you can contact us, the number 1800 065 753 if you want to talk to one of our financial planners. Yeah, hopefully that helps with your question.
Well, thank you, Scott. As I mentioned earlier, it's now time to wrap up our session today. The minutes of this meeting and the written responses to the questions answered and those we couldn't get to will all be available on our website. We'll make sure before the end of the month that they're available on the Equip Super website. So we have reached the point where it's my great honour to conclude our inaugural annual members meeting. There will be a survey once we close the webinar, and I'd be grateful if you could just take a few moments to give us some feedback, because this was an important opportunity. We worked very hard to try and prepare for today to brief each and every one of you. And so we'd be grateful for your feedback, and so we can make the next annual member meeting and improve our communication even better. So on behalf of the Equip Super Board, the management team, and indeed all who worked so hard for today, thank you for your time. Thank you for your support. It's a privilege to serve you, and we look forward to doing that for many years to come. I hope you have a wonderful afternoon. Thanks very much.